All right, welcome everyone. Thanks for joining us today. We have a special presentation. Usually you guys have to tolerate me speaking for a half hour, 45 minutes on different topics from self-directed retirement accounts to some real estate investments. And today we thought we'd make this a little bit more fun and bring in some horsepower. So we have with us today Mr. Steve Davis, the CEO of Total Wealth Academy. Steve, thank you so much for joining us today.
Thank you for having me. Pleasure to be here.
Absolutely. So I've gotten to know Steve a good bit over the last year or so. Total Wealth Academy, as I'm sure Steve will speak about, is a really interesting concept. He's created this community of business owners, entrepreneurs, specifically focused in kind of the real estate asset class, individuals that are investing in real estate from kind of the single family house world to some large, really impressive multifamily syndication type of real estate projects. And so we've been fortunate to be a vendor for Steve and his organization and have some mutual clients there. And so we thought it'd be a great idea for Steve to come in and kind of give his view of how to kind of create wealth and how to think about planning for passive income streams and ultimately how to be able to pay your bills without actually having to work a job. And so, again, I think this is going to be an interesting discussion. And Steve, I really appreciate you joining us.
My pleasure.
And so for those of you that are new to our platform, I'm Sean McKay with American IRA. And so the first few minutes, we'll talk briefly about the idea of self-directed retirement accounts, what that means to you as an investor, perhaps as an entrepreneur, how you can utilize these tools. But again, today, really the focus is going to be on Steve and his knowledge and how he thinks about the world of finance and investing and what have you. So ultimately, when I think about retirement accounts, when I think about the ability to be able to retire, I think that we're entering a new world. And we have to kind of be aware that the game is changing, if you will. And so one of the things that I've been really passionate about over the last few years, and you hear me speak a lot, whether it's in webinars or in person, is this idea of this kind of traditional legs of the table, if you will, that combined have historically allowed individuals to be able to retire. This is something that, again, is changing, and it's never going to be the same. So if we look at previous generations, we've seen that perhaps our parents or our grandparents were able to retire from a company, and they had a lot of different sources that would allow them to be able to retire. And so first and foremost, there was typically a really healthy pension plan that those individuals could rely on. So they'd work for a company for perhaps a few decades, they'd retire, and then that company would continue to pay them in their retirement years this really healthy portion of what they made as an employee at that company. And so certainly for those of you that are kind of thinking about finance and thinking about income streams, you understand this idea of pension plans is really extinct at this point in time, and that's not coming back. And so that first primary leg of the table is really gone. The second concept that I think we also need to be aware of is that Social Security is really in dire straits. So there's all sorts of information out there in the media that Social Security is broken. There's going to have to be a really substantial rework of the Social Security payout system. Just statistically, if we look at it, we understand that there are so many baby boomers that are retiring, and there's proportionally far less people paying into the Social Security relative to people that are actually pulling money out. And so ultimately, for those of us that think we're going to get X, it's very likely that we're going to get a small fraction of that in terms of Social Security income in our retirement years. And so ultimately, what that leaves a lot of us with, and really most of us, is this idea of personal investments and retirement accounts. And so personal investments are tremendous. One of the great things about my job is the ability to learn from and have conversations with incredibly successful entrepreneurs that have built businesses, that have done a great job building rental portfolios, whatever the case may be. The only downside to personal investments is that they're incredibly tax inefficient. So we all understand that when we own an asset, if we ever sell that asset, there's usually a pretty substantial tax bill that goes along with the sale of that asset. So conversely, if we jump to this fourth leg of the table, retirement accounts, the beauty of retirement accounts is that we're able to sell assets and we're able to sell them in a very tax efficient manner. So that's really the premise of what we try to do at American IRA is simply make you aware that this is an increasingly important part of your portfolio. And so what's different about us at American IRA versus the equities-based world where you can deal in stocks, bonds, and mutual funds is that you can still invest in those opportunities with us, but there's this entire world that's also available too. So if you are a real estate investor, so many of the deals that you do as a real estate investor can in fact, excuse me, be made with a retirement account as well. And so if we kind of all accept the premise that retirement accounts are going to be a bigger and bigger part of our financial future, we want to make sure that we're maximizing these retirement accounts and that we're investing in a way where we feel like we're putting our retirement account dollars into assets that we understand. Because the reality is that 90% plus of IRAs and 401ks are invested in some form of the stock market. The problem is that far less than 90% of us are experts in the asset class of publicly traded companies. And so we're putting all of our hard-earned money, all of our savings into investments that we don't understand. And so to me, that's not a recipe for success. Now, I'm the first one to say I can do a pretty reasonable job of buying 1 to 4 family properties in certain pockets of Charlotte, North Carolina, where I work and live and invest. If you ask me to analyze a publicly traded company, even after reading the annual reports, it's basically a coin toss as to whether that company is going to work out or not based upon my analysis. I'm not good at that. I don't have skills in that arena. And so I think a lot of us fall into that category where unfortunately we don't understand these investments that we're putting our IRAs and 401ks into. And so ultimately today, our goal is to make you aware that you don't have to have your IRAs and 401ks tied to the stock market. So when we talk about a self-directed retirement account, which is the baseline of our service at American IRA, it's the same retirement account that you would have with any other financial institution. The difference is that we give you a wider array of investments that you can make with your IRA or 401k. So again, you can still invest in the stock market, but most of our clients are investing in other opportunities outside of just stocks, bonds, and mutual funds. And so at American IRA, we're just simply that financial institution that allows you to use your funds so that you can pick the investments that you believe in, that you think are going to take you to the promised land. And we essentially help you with the paperwork so that your retirement account can make those investments in a compliant manner, because that's ultimately the primary job of a financial services firm, is to assist you with the documentation. We're very different at American IRA because our fee schedule is highly, highly unique. And so typically what you see in the self-directed space is that firms get to charge you a really exorbitant annual fee for the services. And so the annual fee for a self-directed retirement account can be $2,000 to $3,000 if the size of your account is a certain size, in terms of, let's say you have a few hundred thousand or 7 figures in the account, or you have a certain number of assets. But our premise at American IRA is that we're not picking the investments for you, so we shouldn't actually get to see the upside. So we are far less expensive than almost any other self-directed provider that you can do business with. Now, what's great about these self-directed accounts is any retirement account can in fact be self-directed. So if you have an old rollover IRA, let's say, an IRA from an old 401k from back in the day, or a Roth IRA, a SEP or a simple IRA, those can always be converted to a quote unquote self-directed account with us. The only time where your account's going to change forms is if you have an employer-sponsored plan. So let's say you've left your work, you had a 401k or a thrift savings plan or a 403b, you're going to roll that typically into another pre-tax vehicle, such as a traditional IRA. So we can help you with the mechanics of it, but ultimately, for the purposes of this discussion, we just want to make you aware that if you have any of these retirement account vehicles, they can in fact be self-directed. Excuse me. Allergy season in the Carolinas. So when we think about retirement accounts, the way the IRS code is written is it actually tells us what we cannot invest in, which is basically just collectibles and life insurance policies. So beyond that, there's almost limitless opportunities for us to be able to invest our IRAs and 401ks. And so this list of assets is by no means a complete list of options, but some of the more typical investments that we see from our clients. So again, Steve's a real estate entrepreneur. He's an expert in the real estate space. So certainly that's kind of the focus of Steve and his organization. And certainly a lot of our clients are invested in real estate as well. So any type of physical real estate can be owned by your retirement account. So it can be anything from raw land, condos, townhouses, all the way up to multifamily, commercial, industrial buildings as well. A lot of times what we see in organizations like Total Wealth Academy is that you see entrepreneurs that are raising money from other investors to help fund larger scale deals. And so that's something that you can participate in as well. So you might see somebody in a mastermind group or somebody in your network that is raising money for a $40 million apartment complex, and they're raising in increments of 50 or 100K, your retirement account can be one of those investors that gets involved in that project. So we're also seeing a tremendous amount of investment in privately held companies as well. So you might know of somebody in your community that's involved in a startup business, or it's an existing business that's looking to expand. Your retirement account can invest in that opportunity. For those of you interested in digital assets such as Bitcoin, Ethereum, etc., that's another play for these retirement accounts. Precious metals such as gold and silver. So there's a lot of opportunities available to us with our IRAs and 401ks. Now, in the real estate space, the key is to make sure that your retirement account is purely making an investment. So unfortunately, we cannot buy the next home for ourselves and for our family to live in. Typically, it's going to be a rental property. It's going to be a fix and flip property. For those of you working off-market deals, you can do wholesaling or put options on properties. And again, joint ventures is just another way of saying that your retirement account owns a portion of an asset. It could be a portion of a property, a portion of a business, etc. And for those of you that like to be the bank and to lend money to other real estate investors, you can execute that opportunity as well. And so in a nutshell, the way to think about these retirement accounts is that the retirement account is the owner of the asset. And so it pays to acquire this asset, this rental property, we'll say. And as the rental property creates income from the rent, that rent also flows back to the retirement account. So if you think about this in relation to the stock market, there are some companies that pay a dividend. And so if your retirement account owns an individual stock or a mutual fund, it's possible that it pays usually a pretty modest dividend, but that cash flow also comes back to your retirement account. So the same thing is true in real estate as well. The retirement account owns the property, the rental income flows back. If at some point in the future the property is sold, then the net income associated with the sale of that property also flows back to the retirement account. So it's really just a slightly different way that we can think about retirement accounts and how we want to grow our wealth. And so again, we're going to spend most of the time today, Steve's going to share with us his knowledge about investing and about passive income. And so again, Steve is located in Houston, Texas, Total Wealth Academy. That's kind of the headquarters there, but they have a tremendous network nationwide as well as internationally. So they have a big network to get plugged into so that you can start to learn from other real estate entrepreneurs, perhaps look at opportunities, et cetera. So Steve, we'll hand it over to you. Thanks so much for joining us again.
All right. Thank you for having me. I sure appreciate it. I think one of the things that we need to start off with is a definition of retirement. a lot of people associate age to retirement, and age has nothing to do with retirement, except that the poor and the middle class belief system is you work for 45 years, save money, retire, and live off your savings. But that's no longer, well, it's never been true. We have students in their 20s that are by definition retired. The definition of retirement that we use is as soon as your passive income meets and exceeds your wants and needs, you're retired. In other words, I retired at 30 because I was making enough money that it paid all my bills and plus some. I wasn't rich, but to me, I was rich because I didn't have to work a job anymore. And I had a super high quality of lifestyle as a result. But be aware, as soon as your passive income meets and exceeds your wants and needs, you're retired. You don't have to go back to work. So an example would be, let's say that your bills, everything from house note, car note, garbage, gas, electric, is $5,000 a month. Well, if you generate $10,000 a month in passive income, you've got $5,000 a month to pay all your bills and $5,000 for fun, travel, romance, and so on. The focus for wealthy people is to build that second stream of income. And it's based off of a principle that was brought to light by Warren Buffett, who said some 30 years ago, never rely on a sole source of income, a job. Always invest to create a second stream of income. And many people mistook what he said for gold, silver, stocks, things like that. That was not what he was talking about. The reason is those things don't produce monthly income. He was talking about income producing assets. And that's what we do at Total Wealth Academy is we are buying single family houses, little apartment complexes, 500-unit apartment complexes, senior living, RV parks, mobile home parks, strip shopping centers, hotels, anything that's backed by real estate and produces cash flow, that's what we're investing in. And what our members do is they educate themselves to a level where they become what the government terms a sophisticated investor. They actually understand what they're investing in, almost as much as the actual sponsor or syndicator they're investing with. So a sponsor is a member of Total Wealth Academy that finds the deal, negotiates the deal, closes the deal, and manages the deal. They're the active investor in the deal. Then 40 or 50 members, other members, each put up 50,000. Some may put up 500,000. But let's say the sponsor needs to raise 20 million to buy a $50 million apartment complex. It might be 40 people that put up the money, and then the sponsor goes and runs it. And then the sponsor sends the passive investors a check every quarter or annually, however the deal is set up. So that's what we're doing. And it's really, as the slide says, it's no longer an option. The reason is, according to Robert Kiyosaki, and he really got this information from the US government, 95% of Americans fail to retire by age 65. The average savings for a 65-year-old in the United States is $170,000. Nobody's retiring on $170,000 when our wives are going to live 18.5 years in retirement. Men, we're going to live a little less than that, probably closer to 15 years. 170,000 divided by 15 or 18 years, that's about 10 grand a year. Again, nobody's retiring on that. The good news is, if you study the 5% that do retire successfully, almost all of them have built a second stream of income. That's what allows them to retire. And 70% of them used real estate to build that second stream of income. By the way, this is a little negative, but remember when I said 95% of Americans fail to retire? That includes the fact that 30% of us are dead by age 65. So 65% that is left, they can't retire. They have to continue working. So let's go through these slides, and I think this will make sense as to why you've got to have a second stream of income. Okay, first off, let's make a distinction. Speculation and investing are two different things. They're two different things. Stocks, gold, silver, crypto are speculation. You only make money when it goes up in value. You're buying low to sell high. Whereas this is actually gambling. And here's why. You turned 70 in 2007. You're screwed. If you were speculating in the stock market, gold, silver, whatever, and the recession came and your assets dropped in value 20, 30%, and that's the year you retired, that is, you're gambling with your life by saying, oh, it won't crash when I retire. Well, you need to be aware that the stock market has crashed 18 times in the last 100 years, 18 times. That's about every 6 years, which brings another funny point up. I love when people get upset when the stock market crashes. It's like, what are you talking about? It did it 18 times in the last 100 years and you're shocked and you're upset. You should not be shocked. You should not be upset. That's what it does. The stock market for the last 75 years has averaged a 7.5% rate of return, even with the ups and even with the downs. So for you to get upset or worry about it means you don't understand what you're invested in. It's 7.5%. That's it. That's all you're going to get from the stock market. And if you're okay with that, I'm not. I'm used to 20% rate of return in real estate. If you're okay with the 7.5% rate of return, then just stick with it. Don't worry about the ups and downs. You're still going to get 7.5%. But the gamble is going, the stock market's not going to crash when I retire. See, that's foolish and that's dangerous. And that's why speculators get slaughtered while investors who invested for cash flow continue to make their cash flow. If you go back to 2007, I was in about 4,000 apartment units. Let's say I was making the equivalent of 80 grand a month in cash flow. The market crashes. All my properties drop in value 20, 30%. Am I worried about it? No. Why? What's my cash flow? It's still $80,000 a month. See, cash flow remains even in a recession in real estate, if you know what you're doing. Now, it does require education, but if you know what you're doing, you're getting your cash flow anyway. Yeah, property values drop, because it's not if real estate's going to drop in value, it's when. The good news is it's not if it's going to come back up in value, it's when, just like the stock market. It's not if the stock market's going to crash, it's when. It's not if it's going to recover, it's when. Same for stocks, same for real estate. The difference is cash flow. You still continue to make your cash flow. So if you had your money in real estate and you turned 70 in 2007, you wouldn't care. Remember, the market has crashed 18 times in the last 100 years, or about every 6 years. An investment produces cash flow and appreciation, But the way we look at it in real estate is cash flow is the cake. Appreciation is the icing on the cake. We may or may not get it that particular year. Yes, we get it in the long run, just like stocks do, but our rate of return is 20+% compared to the stock market's 7% or 7.5%. You invest in an apartment and make 10K a month in passive income. 2007 comes along. What happens? Your property dropped in value 40%. Do you care? No. You continue to make $10,000 a month. So make the distinction in your head. Investing and speculation are two different things. If you're in the stock market, you're a speculator, not an investor. Now, back to why you need passive income. Saving your way to retirement doesn't work, period. This can be a brutal point, but I want you to think about this. Savers are losers. The reality is today's money has fake value and it's making you poorer. And if you're a saver, you're a loser. You're going to lose in the end. 2, to have $10,000 a month in retirement, look at that number. You must save $3 million. That's, of course, using the 4% rule. The 4% rule, if you're not familiar with it, is when you retire, you're only allowed to take 4% of your savings out each year to ensure that you don't run out of money before you die. 4% of 3 million is $120,000 divided by 12 months. That's $10,000 a month. The third, let me go. Well, I don't know how to go back. So you're looking at number 4. I already said it. The IRA and 401k are epic fails for America. Now, what do I mean by that? In 1974, when they kind of did away with all of the pensions and they kind of made us responsible for our retirement. They said, look, no more pensions. You're now responsible for your own retirement, and we're going to let you do it in a tax-deferred method, the IRA and 401k. Well, I want you to think about this. Did you know that an IRA and 401k only save you taxes if you fail financially? They only save you taxes if you retire with low income. Now, how many of you listening to this have a goal? Man, I want to retire with low income. That's nobody's goal. See, let's say that you save up $1 million in your IRA and you made $100,000 a year while you were working. While you were working, you were in the 23% tax bracket. You retire. You take $100,000 out of your IRA the first year. Guess what tax bracket you're in? 23%. The same tax bracket you were in when you were working. The IRA and 401k do not save you taxes unless you retire with low income. And again, that's nobody's goal. So be cautious using those tools. We use them, but we're investing passively with them. And again, getting a 20% internal rate of return, which is about 3 times what people in the stock market are making. And then, of course, number 4 is just proof that saving your way to retirement doesn't work. I mentioned it earlier, 95% of Americans fail to retire by age 65, 28% are dead. They're working at Walmart because they cannot retire. So men, your wife will live 18.5 years after you're gone. Are you prepared for that? Do you have that money in savings? If not, it's time to look at a second stream of income for your wife. The other misconception people have, I love this one. People think their bills get lower as they get older. They don't. They don't. They say to themselves, well, I won't have kids at home. I won't have to pay for college, blah, 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 blah. It's not true. Your health insurance and your health costs are going to be higher than raising kids and putting them through college. Your bills do not get lower as you grow older. The poverty among the elderly is growing rapidly. The fourth reason you don't want to try to save your way to retirement is you miss out on life. You just, they tell you to scrimp and save. They tell you to put it off till you retire. That's when you travel to Greece. That's when you take the cruises. I know what I'm about to say is brutal. Retirement sucks. Getting old sucks. The golden years are a golden lie. It's a bunch of crap. It is way better to make love to your wife under the Eiffel Tower in France in your 30s and 40s than it is in your 60s and 70s. You want to live now. You don't want to be rich when you're old. You want to be rich now. And then by doing that, you'll be rich when you're old too. It's just kind of a default thing. And by the way, the comment about retirement sucks. I retired at 30. You know what I did 6 months later? Went back to work. Why? You can only fish so much. You can only watch so much sports. You can only do whatever, gardening, whatever you think you're going to do in retirement. Yeah, after about 3 months, you're bored with it. And you start to wonder, what is my purpose in life? I'm not doing anything. I'm not serving other people. I'm not helping other people. Retirement sucks. So be aware of that. Keep that. I know it's hard to swallow the first time I say it, but go talk to some people who are retired. They'll back me up on this one. Why should you use real estate to build your second stream of income? First, you can retire at any age. As I said before, age has nothing to do with retirement. Your passive income dictates that. 2, of the 5% that retire at or before age 65, almost all of them have a second stream of income. 90% used real estate. Now, this is the worldwide statistic. The United States statistic is the 70%. 90% worldwide used real estate to produce that second stream of passive income. 3, real estate is the lowest risk investment out there. Why? Because we make money in both the up and down markets. And look at that bottom line. We make more in the down market. Let me poke fun at REITs, real estate investment trusts. This is the worst investment I've ever seen. I've never seen anything worse than a real estate investment trust. The reason is they're flow investors. When they raise $8 billion, they have to get that $8 billion invested in a short period of time. This prevents them from seeking out the best deals, from understanding what they're buying. We sell our real estate to REITs all the time. Why would we sell to REITs? Because they always overpay. Go back to 2021. The REITs were buying single-family homes, weren't they? Hundreds at a time, and paying $20,000, $30,000 above market value. Recently, prices have softened and prices have dropped. You know what the REITs are doing? They've stopped buying real estate. They've stopped buying single-family homes. How many of you have figured out what's wrong with that? They did it backwards. They bought at the high and they got out of the market when the prices dropped. They shouldn't have been buying in 2021 and they should be buying right now. REITs are incompetent, unprofessional, and they make their money off of fees up front, and you don't make anything for 20 years. All right, next slide. Conclusion. To have the highest quality of lifestyle, to live well while you're young, to be able to retire at any age, you must have a second stream of income. You must have passive income. At Total Wealth Academy, that's what we train our students to do. And we're creating it, as I mentioned, through apartment complexes, senior living, self-storage, RV parks, you name it. If it's real estate backed and produces monthly cash flow, a second stream of income, that's what we're buying. And that's really my main points about why you need a second stream of income. If anybody has any questions, feel free to email me. You can also go to totalwealthacademy.com and check out a free sample class to see how our educational system works and how we're building wealth for ourselves and our members. All right, thank you for listening.
Really appreciate your thoughts there, Steve. It was definitely it was an interesting take on kind of how you see income flows and things of that nature. We have had a few questions come in, and so if you don't mind, I'll just kind of fire away at you.
Go ahead.
Excuse me. So the first question revolves around just the state of the market. So what are you guys seeing out there in the larger multifamily space? Do you feel like there's a real softening coming? What's happening there?
Well, we buy property in both the up and down markets. I will admit that we buy more in the upcoming down market. We were negotiating on a 527 or 530 unit apartment the other day, and they reduced their price by about 3 million. We were negotiating on 127 units, and they lowered their price by 1.5 million. So yes, there is a softening in the market, but I worry about that question because whoever asked it thinks they're going to pick the right time. Is this the right time? Is this the right whatever? And that's speculation. You don't do that. We make money buying in the up market. We make money buying in the down market. We make it when we're going down. You have to know what you're doing, of course, but you don't want to turn real estate into a speculation where you're trying to pick the right time. If you know what you're doing, you're going to make money at any time. But I will admit we're going to make a lot more money in 2023 and 2024 compared to 21 and 22.
That makes sense. And so a lot of the offerings that we've seen over the last number of years, the plan A has certainly been to exit that, whatever it may be, apartment complex, we'll say, in somewhere around a 5 to 7 year window.
Yes.
Is that what you think a lot of these general partners, a lot of these syndicators are kind of project? Let's say they're buying an asset now in the next few months, et cetera. Do you think that time frame is still what they're looking at in terms of a 5 to 7 year, or do you think they're pivoting to bracing for more of a longer term hold?
No, we're still looking at 5 to 7 years. The average recession lasts about 3 years. So anything we buy now, we'll probably liquidate in 5, I would say 7 years at the max. There are some new construction we're doing that'll be a 10-year play. But yeah, you're right. 3, 5, 7 years is what we're looking at.
Okay, great. So we do have some specific questions, Steve, about Total Wealth Academy and what have you. So excuse me, it's important that before we delve into this, I do want to make sure, this being on the American IRA platform, again, as I mentioned, we do have mutual clients with Total Wealth Academy, with Steve and with his group. From a legal standpoint, as a self-directed provider, we always have to be neutral in our clients' investments. Excuse me. So Steve's obviously a great resource. He's got a lot of experience in the real estate space. And so we definitely think it's a value add for him to come on and speak about the real estate asset class. But with that being said, we want to make sure that it's understood that American IRA is not promoting a particular investment or a group of investors that we're steering clients towards to invest into their opportunities. So with that as the background, so the first question is, Steve, do you have any partners that you recommend for investment? So could you speak a little bit more perhaps about the Total Wealth Academy model, how you work?
Sure. We have about 30 or 35 sponsors in our group, and each one specializes in their particular space. So we only have 2 in the senior living space, probably about 20 in the apartment space, 3 or 4 in the self-storage space, a couple in the mobile home space, a couple in the RV space. So about 30, 35, yes.
Okay, terrific. And so this is kind of delving into the next element here. So the next question revolves around the education piece. So do you train the members, Steve, in terms of how to evaluate properties? Is it more of a networking opportunity? How does that look?
It's a combination. It's networking because you've got to meet the 35 sponsors, but my students go through 14 hours of training. They understand NOI, net operating income. They understand internal rate of return. They understand equity multipliers. They understand. My members can literally look at an apartment complex and tell you the value of it. So what's happening out there in the internet space is these sponsors know more than the investors, and they don't even mean to take advantage of the investors. I'm not saying they're bad people, but it happens because these non-educated accredited investors, just because people think I'll take an accredited investor into my deal. All that means is they have $1 million in the bank. That doesn't mean they understand the apartment complex or understand how it works, what the ups, what the downs are, and they're getting burned. You want to be a sophisticated investor so you know almost as much as the sponsor when it comes to doing the deal. So yes, we educate our students to a level where that they almost could go out and buy their own apartment complex.
Beautiful. I like that. So the next question is, who picks the properties to buy? So assuming Joe Smith comes in and he's being educated, Steve, by you and your team, does Joe have the opportunity to identify the specific asset, the specific group that he wants to work with? How does that look?
The sponsor is responsible for locating the deal, negotiating the deal, of course, analyzing the deal. And then we have 2 different protection levels beyond that. We run through the deal as well, completely independent of the sponsor. And then a lot of, people talk about banks and they kind of say negative stuff about banks, but banks are your friend if you know what you're doing. The bank is the 3rd level of protection because their underwriters are going to go through the deal as well. So you've got the sponsor, you've got us and the bank. You've got 3 sets of eyes on the deal before it ever gets done.
Got it. So you're bringing essentially a multi-layered underwritten deal to potential investors.
You got it.
Great. Appreciate that. Can you talk a little bit, just broad strokes? So you mentioned apartment complex, you have a number of syndicators in that space. Could you talk a little bit about the general structuring of the debt on those things in terms of amortization, call dates on the debt? How does that look?
Yeah, a 35,000 foot look. We generally buy them with a bridge loan, and the bridge loan is an adjustable rate. It does have a 5-year term. It's usually amortized for 25 years, sometimes 20, sometimes even 30, believe it or not. And we use the bridge loan just long enough to rehab the project. So let's say that we've got $1 million rehab and it takes us 6 months to complete that rehab. At the end of 6 months, we're going to go into a regular loan. That's just, it may have a 5-year adjust, but it's and it's non-recourse. That's the other neat thing about it, is when you buy the property, it's a recourse loan, personal liability for the sponsor, not for the passive investors. So the sponsor takes personal liability on the original bridge loan, but once they refinance it, then there's no personal responsibility. And there's your basics, but I'm not a financing expert. There's a lot to it, and there's many different types of loans that you can use.
Love it. Good stuff. Excuse me. Okay, so looks like perhaps the last two questions. So Steve, what is the minimum and maximum investment, and what are the fees to participate? So is there kind of a membership fee for Total Wealth Academy? How does that look?
Well, the passive investors range, the minimum for a passive investor is $50,000. There's really not a maximum, but personally, I've never put more than $500,000 into one deal. And the reason is I follow Andrew Carnegie's point. What Andrew Carnegie said was put all your eggs in one basket and spend your entire life making sure nobody kicks over your basket. And so what I do is I like to have multiple apartment complexes, some senior living complexes, some self-storage, whatever. Those are my eggs, but it's one basket, which is real estate. Our basic membership is $500, and that covers people for 2 years, but they really need to go to Total Wealth Academy before they say, I'm going to do it. They need to go to totalwealthacademy.com and register for that free sample class. This is a 1-hour class that gives you an overview of everything that we're doing. And then if you decide to enroll and take the $500 program, you take a virtual 6-hour class with me, where I go over every aspect of single family investing, and then even go into passive investing for the second half.
Okay, great. Again, totalwealthacademy.com. Feel free to email Steve at totalwealthacademy.com. Phone number is 713-201-7784. So again, Steve, really appreciate the knowledge and the time today.
My pleasure.
Again,
I would like to say something though,
sure.
And I don't want people to be shy about using that email address. Some people say, they think I'm some big shot. I love email. If you've got a fear, you've got a concern, you've got something that is bothering you, fire me an email. It comes directly to me. I'm not going to put you on a mailing list. I'm going to answer the question, and I love doing it. I literally get a dopamine rush when I answer emails. I must be the weirdest guy on the planet, but I love it. So don't be shy. Write down that email. If you need me, that is my cell phone, but it'll go straight to voicemail, and I'll call you back.
Perfect. No, I can understand that. I can appreciate that viewpoint. Anytime I have the opportunity to interact with our clients, that's, as I tell them, that's the most fun part of my workday. So
yeah, if you love what you're
great.
doing, it's fun when people ask you questions. It's just a blast, especially when they ask a question that you can answer, and then that empowers them to take action. It's a lot of fun.
I love it. That's a great way to look at it. Unfortunately for our clients, I'm not always the best resource, so I can steer them to somebody who's going to be more helpful. But all joking aside, again, Steve, I really appreciate the time today. Phenomenal
Thank you, Sean.
resource. So again, Steve with Total Wealth Academy. a good source for networking, a good source for education. And we appreciate the time today. So thank you so much, Steve.
Thank you. Thank you.
Absolutely.